All right, everyone, welcome back to the AG Insider. I'm Captain Silver, and we need to talk about what is happening right now because the global financial system is officially breaking, and the ultimate proof is flashing right in front of our eyes. Gold has just violently smashed through the $5,100 an ounce barrier as central banks and billionaires panic by tangible wealth. But while the mainstream media focuses on gold, they are completely ignoring the mathematical anomaly happening in the physical silver market. A historic wealth transfer is about to trigger, and silver is the coiled spring. The suits want me to tell you this isn't financial advice. Of course it isn't. It's a survival guide for a burning theater. Do your own research if you still trust the people who stole your purchasing power. But let me ask you right now, with gold priced completely out of reach for the average person, are you aggressively stacking physical silver to take advantage of the historical ratio, or are you sitting in paper cash? Let me know your exact strategy in the comments below, because I need to understand who is actually positioned for what's about to happen versus who is going to be left behind. Let me break down the core mechanics of the precious metals market, because this is the foundation of understanding why silver is about to explode. The gold to silver ratio, which I'm going to refer to as the GSR, is one of the most important metrics in the entire commodity market. The GSR tells you how many ounces of silver it takes to buy 1 ounce of gold. You calculate it by dividing the price of gold by the price of silver. Right now, with gold near $5,188 and paper silver artificially suppressed down to $86, the ratio is sitting at roughly 60 to 1. That means it takes 60 ounces of silver to buy 1 ounce of gold. Now let me explain why this number is absolutely critical and why it's telling you that silver is about to have the most explosive move in modern financial history. Historically, the gold to silver ratio has averaged much lower than 60 to 1. If you look at the past few thousand years of human civilization, when gold and silver were both used as money, the ratio was typically between 10 to 1 and 15 to 1. In ancient Rome, the ratio was about 12 to 1. In the United States in the 1800s, when both gold and silver were legal tender, the ratio was fixed by law at 15 to 1 for a period of time. Even in the 20th century, before fiat currency took over completely, the ratio averaged around 30 to 1. The key point here is that when both metals are functioning as money, when they're both being used as stores of value and mediums of exchange, the ratio tends to stabilize at a much lower level than where it is today. Now let me explain what happens during major geopolitical and monetary collapses. During times of crisis, during times when the financial system is breaking down, the gold to silver ratio aggressively and violently snaps back toward its historical monetary average. We saw this in 2011 during the European debt crisis, when the ratio dropped from over 60 to 1 down to below 32 to 1 in a matter of months. We saw it in 2020 during the COVID pandemic, when the ratio spiked to over 120 to 1 and then crashed back down to 64 to 1 within a year. The ratio is not static, it's dynamic, and it moves violently in response to market conditions. And right now, we are setting up for the most violent snap in the ratio that we have seen in modern history. Let me do the math for you, because the math is undeniable. If gold stays exactly where it is today at $5,188 an ounce, and the gold to silver ratio reverts to its historical average of 30 to 1, that puts silver at $172 an ounce. If the ratio goes to 15 to 1, which is entirely possible during a monetary crisis, that puts silver at over $345 an ounce. We're currently at $86. That's a double to get to 172 and a quadruple to get to 345. Even if gold doesn't go higher, even if gold just stays flat at 5,188, silver has to double or triple or quadruple just to correct the ratio. And here's the kicker. Gold is not going to stay flat. Gold is going higher. Central banks are buying gold at record rates. Geopolitical tensions are escalating. The dollar is weakening. Inflation is accelerating. Gold is going to 6,000, it's going to 7,000, it's going to 10,000 or higher. And as gold goes higher, silver has to go even higher to correct the ratio. Now let me explain why the ratio is so distorted right now. The reason the gold to silver ratio is at 60 to 1 instead of 30 to 1 or 15 to 1 is because of manipulation in the paper silver market. The big banks, particularly JP Morgan and the other bullion banks, have been shorting silver on the COMEX futures exchange for decades to suppress the price. They use the paper market to create the illusion of abundant supply, and they drive the price down by short-selling contracts that they have no intention of delivering on. This manipulation has kept silver artificially cheap relative to gold, and it's created the most distorted gold-to-silver ratio in modern history. But the manipulation is breaking down. The physical market is taking over, and when the physical market takes over, the ratio is going to snap back violently. Let me give you some context on what's happening in the physical silver market right now. Industrial demand for silver is exploding. AI data centers require massive amounts of silver for their servers and their power distribution systems. Solar panels require silver for the electrical contacts. Electric vehicles require silver for the battery management systems and the advanced electronics. 5G infrastructure requires silver. Defense contractors require silver for missiles and radar systems and electronic warfare. The industrial demand for silver is growing faster than the supply, and this is creating a structural deficit in the market. According to the Silver Institute, the global silver market has been in a deficit for multiple years, meaning more silver is being consumed than is being mined. And that deficit is growing. Now let me talk about what's happening in the COMEX vaults, because this is where you can see the physical supply being drained. The COMEX maintains vaults where physical silver is stored, and they categorize that silver into two buckets: registered and eligible. Registered silver is available for delivery against futures contracts. Eligible silver is in the vault, but it's not available for delivery. It's privately owned. The amount of registered silver in the COMEX vaults has been declining dramatically over the past few years. We're down to levels that are dangerously low relative to the number of outstanding futures contracts. This creates a situation where if too many contract holders demand physical delivery, the COMEX won't have enough metal to deliver, and the entire paper market will collapse. And when the paper market collapses, the price of physical silver is going to go vertical. The smart money knows this. They are quietly draining the COMEX vaults by taking delivery of physical metal. They are buying futures contracts, standing for delivery, taking the metal out of the vault, and storing it privately. Every ounce that gets taken out of the COMEX system is one less ounce available to suppress the price. And as the registered silver inventory gets lower and lower, the risk of a delivery default gets higher and higher. We are getting very close to the breaking point, and when we reach that breaking point, the suppression mechanism is going to fail and silver is going to explode. Now let me explain why the $5,100 gold price is actually a blessing in disguise for the smart retail investor. At $5,100 an ounce, gold is completely out of reach for the average person. If you have $5,000 to invest, you can buy 1 ounce of gold. That's it, 1 ounce. But with that same $5,000, you can buy over 58 ounces of silver at current prices. And when the gold to silver ratio corrects, when silver doubles or triples or quadruples, those 58 ounces of silver are going to be worth far more than that 1 ounce of gold in percentage terms. The high price of gold is pushing retail investors out of the gold market and into the silver market, and that's creating massive buying pressure on physical silver. Central banks are hoarding gold. They are buying gold by the hundreds of tons. China is buying gold. Russia is buying gold. India is buying gold. Central banks around the world are accumulating gold reserves because they know the dollar is dying and they need a hard asset to back their currencies. But central banks are not buying silver. Silver is too bulky, too industrial, too volatile for central banks. That leaves the silver market wide open for retail investors, for institutions, for industrial users. And the demand from all of these sources is overwhelming the available supply. Now let me talk about the pricing error that exists in the silver market right now. At $86 an ounce, silver is severely undervalued relative to gold, relative to its industrial demand, relative to its scarcity, and relative to the inflation that's coming. The market has mispriced silver because of the paper manipulation, and that mispricing is creating the opportunity of a lifetime for people who understand what's happening. When markets misprice assets, smart investors exploit that mispricing. They buy the undervalued asset and they wait for the market to correct. And when the market corrects, they make enormous returns. That's what's happening with silver right now. The market has mispriced silver, and the correction is coming. Let me give you some historical examples of what happens when the gold to silver ratio snaps back. In 1979 and 1980, during the last great inflation and geopolitical crisis, the Hunt brothers tried to corner the silver market. The price of silver went from around $6 an ounce in 1979 to over $50 in early 1980. That's more than an 8x move in less than 2 years. The gold to silver ratio dropped from over 30 to 1 down to below 17 to 1 during that period. In 2011, during the European debt crisis and the aftermath of the 2008 financial crisis, silver rallied from under $9 in late 2008 to nearly $50 by April 2011. That's a 5x move in less than 3 years. The gold to silver ratio dropped from over 80 to 1 down to below 32 to 1. In 2020, during the COVID pandemic, silver rallied from $12 in March 2020 to nearly $30 by August 2020. That's a 150% move in 5 months. The ratio dropped from 123 to 1 down to 64 to 1. Every time there's crisis, every time the financial system comes under stress, silver outperforms gold on a percentage basis, and the gold to silver ratio compresses. And we are heading into the biggest crisis in modern history. We have a war in the Middle East. We have central banks printing money. We have inflation accelerating. We have the dollar losing reserve currency status. We have a debt crisis. We have a banking crisis. We have a geopolitical crisis. All of these factors are bullish for precious metals, and they are especially bullish for silver because silver is more volatile and more leveraged to the upside than gold. Now let me talk about the mechanics of how the ratio snaps. When the gold to silver ratio is high, it means silver is cheap relative to gold. Smart investors recognize this, and they start swapping their gold for silver. They sell 1 ounce of gold and they buy 60 ounces of silver. This creates selling pressure on gold and buying pressure on silver, which causes the ratio to compress. At the same time, industrial buyers and retail investors are buying silver because they need it or because they see the value. All of this buying pressure pushes the price of silver up faster than the price of gold, and the ratio compresses. And once the ratio starts compressing, it creates a momentum effect. Traders see the ratio moving, they pile in, algorithms start buying, and the move accelerates. This is how you get these violent snapbacks in the ratio where silver doubles or triples in a matter of months. Now let me talk about the supply situation, because the supply of physical silver is extremely tight. Global silver mine production is around 830 million ounces per year, and that production has been flat to declining for years. The industrial demand alone is consuming over 600 million ounces per year, and that number is growing. Investment demand is consuming another 200 million ounces or more. That leaves very little silver available for the market, and when there's a surge in demand, there's not enough supply to meet it. This creates the perfect setup for a price spike. And here's the critical point. Unlike gold, which is primarily a monetary metal, silver is both a monetary metal and an industrial metal. That means the demand for silver is inelastic. Industrial users need silver to manufacture their products, and they're going to buy it regardless of the price. If the price goes to $100 an ounce, they're still going to buy it because the cost of silver is a small fraction of the total cost of their products. This inelastic demand puts a floor under the price and ensures that any supply shortage is going to result in a price spike. Now let me talk about what's happening with the mints, because this is another sign that physical supply is tight. The U.S. Mint, the Royal Canadian Mint, the Perth Mint, and other government mints around the world are struggling to keep up with demand for silver coins. They are reporting delays, they are rationing products, they are running out of inventory. When the government mints can't keep up with demand, that tells you that the physical market is under stress. And when the physical market is under stress, the premiums go up and the availability goes down. We're already seeing premiums of $5, $6, $7 or more over spot for silver eagles and other popular coins. When the squeeze really starts, those premiums are going to explode to $15, $20, $30 over spot or more. Let me talk about the difference between owning gold and owning silver from a retail investor's perspective. If you own 1 ounce of gold at $5,188 and gold goes to $10,000, you've made a 93% return. That's a great return. But if you own 60 ounces of silver at $86 each and silver goes to $172 due to the ratio correction, you've made a 100% return. And if silver goes to $345, you've made a 301% return. Silver gives you more leverage to the upside because of the ratio dynamics and because of the lower starting price. This is why retail investors should be focused on silver, not gold. Now let me address the argument that some people make that silver is too volatile and too risky. Yes, silver is volatile. It can swing 10, 20, 30% in a matter of weeks. But that volatility is exactly why the upside potential is so massive. If you want safety and stability, you're not going to get life-changing returns. If you want life-changing returns, you have to accept volatility. The key is to size your position appropriately, to buy physical metal, to take delivery, and to hold for the long term. Don't try to trade in and out of silver. Don't try to time the market. Just accumulate physical ounces and wait for the ratio to correct. Let me talk about the importance of buying physical silver versus paper silver. Paper silver, whether it's an ETF like SLV or a futures contract on the COMEX, is not the same as physical silver. Paper silver is a claim on silver, but it's not the metal itself. In a crisis, when the system is under stress, paper claims can be defaulted on. They can be cash settled. They can be frozen. Physical silver is real. It's tangible. It's yours. When you hold a physical silver coin in your hand, you own it outright, and no one can take it away from you. This is critical in a crisis. Now let me talk about the timeline because people always want to know when this is going to happen. The gold to silver ratio is already starting to compress. It was over 90-1 during the COVID pandemic, and now it's down to 60-1. That's significant compression, but we're still far from the historical average. As the crisis intensifies, as central banks keep printing money, as geopolitical tensions escalate, as the physical supply of silver gets tighter, the ratio is going to compress further. My estimate is that we're looking at 12 to 24 months before the ratio gets down to 30-1 or lower. But it could happen faster if there's a major catalyst like a COMEX default, a geopolitical shock, or a currency crisis. Let me talk about what you should be doing right now. You need to be buying physical silver, not paper, physical. Go to your local coin shop, call a reputable online dealer, buy silver eagles, buy silver rounds, buy silver bars, take delivery, store it safely, and hold it. Do not try to time the perfect entry. Do not wait for a pullback. Just start accumulating. Every ounce you buy today at $86 is an ounce that could be worth $172, $345, or more in the future. This is not speculation. This is mathematical probability based on the historical ratio. Now let me talk about the endgame. When the gold to silver ratio corrects to 30 to 1 or 15 to 1, it's going to represent one of the greatest wealth transfers in modern history. The people who accumulated physical silver at $80, $90, $100 an ounce are going to see their wealth multiply. The people who stayed in paper assets, who trusted the government, who believed the mainstream media, are going to see their purchasing power evaporate. This is a binary outcome. You either position yourself correctly or you get left behind. There's no middle ground. Let me address the people who say that the ratio will never correct, that the manipulation will continue forever, that silver will never break out. Those people don't understand history. Every manipulation eventually fails. Every suppression scheme eventually collapses. The paper market for silver is built on a foundation of sand, and when the physical buyers overwhelm the paper sellers, the whole thing is going to come crashing down. And when it does, the price of silver is going to explode, the ratio is going to compress, and the people who position themselves ahead of time are going to be rewarded. The $5,100 gold price is a flashing red warning sign. It's telling you that the financial system is breaking, that fiat currencies are being debased, that central banks are panicking, and that hard assets are the only safe haven. But gold is out of reach for most people. Silver is the opportunity. Silver is the undervalued asset. Silver is the coiled spring. You must exploit this massive pricing error and secure your physical silver ounces locally right now, before the ratio violently snaps and the industrial shortages push silver into triple digits forever. The paper suppression on the COMEX is failing and the physical market is taking over. You need to hit the subscribe button and turn on the bell notification right now so you receive my emergency broadcast the exact second the gold to silver ratio officially breaks and the historic silver squeeze begins. This is not optional. Your financial future depends on being informed and being positioned ahead of the crowd. Subscribe now, turn on notifications, and prepare for the wealth transfer. If you want to understand exactly why your paper assets are about to be wiped out while physical metals explode, you must click the video on your screen right now. I expose the terrifying $1.8 trillion private credit crash that Wall Street is hiding from you. Do not wait. Click right here, and I will see you in that video.